the lower interest rates really boosting the options for financing? Joining me here in the Dukascopy studios here in Geneva to discuss is Mirco Coccoli and Svet from MPD Partners. Welcome.
Thanks for receiving.
So, what are the implications of lower interest rates in the capital market?
As commonly known in capital markets, a low interest rate environment is also used to improve asset values. So, in general, companies' valuation, this is normally stabilizing the economic environment, so the tendency to stabilize the economic environment, and does to improve the valuation of companies. There are other reasons. For example, there is an interesting example of what's going on in the Swiss outlook with respect to the neighboring European community or Eurozone, is that given that the outlook on the Swiss franc is to be a strong currency, a lot of demand for the Swiss franc, the Swiss National Bank is still forced to keep the interest rates low to avoid the effect of a detrimental exchange rate. Excuse me. To avoid the effect of a detrimental exchange rate.
So given that you come from an environment of SMEs, is the current situation benefiting the company?
In theory, lower interest rates should help SMEs boost their businesses, meaning that on the demand side, of course, there should be an increase in the willingness of them to obtain cheaper financing. But the problem is that banks face tighter regulatory requirements, and especially now after the Basel III, they have to comply with higher capital ratios. The fact is that SMEs are perceived a priori as bearing a higher risk, and therefore very often banks are prevented from recognizing their potential for growth. On one hand, banks are under pressure because lower interest rates means that they have lower operating margins, and that's why they have to lend more. But however, the regulatory constraints are more powerful and prevent them from doing so. For example, if we take the example of Italy, which has a very strong culture for family businesses, companies struggle to get credit because they are not perceived as financially sound enough to be eligible for a financing from a bank. There is a shortage in supply, which drives SMEs to look for alternative venues of financing, like private equity investments, issuing of mini bonds, or even crowdfunding. In the end, there is this mismatch in risk appetite between banks and SMEs, which significantly diminishes the positive impact of lower interest rates on this particular segment of the market. Overall, the incentive was good, but the environment of SMEs remains a difficult one, although with a positive outlook.
Great. So do you think the ECB's approach is the right one? So what is your view on the future movements of interest rates in Europe?
Well, the ECB did the right job, because what is important when you are a central bank is to manage expectations. This is in every book of economics. What the ECB did is that they had a clear statement, a clear vision of what they wanted to do for the future. Don't forget the famous sentences like from Draghi, for example, on doing whatever it takes. And this is actually what was done. There is a promise for improving, for slowly increasing interest rates. And this is, of course, mandatory as a promise, but everybody knows in the market that it's difficult to go for it very quickly from now. So it will take a while. The increase in interest rate will take a while to be substantial, to have a substantial change. But the interesting thing is, in this moment, we are in negative territory in the Eurozone and in Switzerland, for example. And this is something that happens rarely, and it is difficult to understand what will happen if we will need to go lower. I honestly don't think that this will happen. I think that it will take that it will go in the positive direction and in a stable way.
Great. Well, Mirco, Maria, thank you so much for coming in today. It was a pleasure speaking to you both.
Thank you.
Well, that's all that we have time for today, but for all the latest updates, do keep clicking back. Goodbye for now.